central banks bought around 244 tons of gold in this quarter one of 2025. It was more than 1,000 last year, I believe, which is more than 25% of the last 5 to 10 years of ever. I believe that's not diversification, that's a declaration. Is this a vote of the no confidence in the dollar? Are we quietly witnessing the birth of post-dollar era, with gold playing the role of the global neutral? Liquidity has been a main pillar of the dollar, but the signs of it we are already noticing in the gold as well. So, sir, is it possible that we are heading towards a future where the physical gold isn't just a reserve, but the collateral for the entire trade agreement? Is it possible that we see an uptick in the gold-backed trade?
So typically what happens is, let's say when you invest in a company or give money to a bank, wherever you put your money, you see the balance sheet of that entity, how strong the balance sheet is. So the one way to hedge your credit risk is that you put gold. So if you are holding US dollar or currencies of countries where the fiscal situation or their balance sheets are not looking great, so how do you hedge that? You have to keep gold, because gold cannot be defaulted upon. If you're a long-term investor, you should not chase momentum. The best time to go buy gold is when nobody's talking about it. So, and that's what we saw in India also in 2024. The flows into gold ETFs almost 3 to 4 times of the previous financial year. So that's why it is not silver or gold, it is silver and gold for your portfolio. The flows into gold ETFs in the Western world return, and this combined with the flows by the central banks turbocharged the gold prices in 2025.
1, 2, 3, 4.
Hello everyone, welcome back to another episode of UpperCrust. So these days there is a lot happening around the world: wars, inflations, and the currency shift. And quietly, gold and silver are back in focus. Are they just metals, or are they becoming the global insurance in the uncertain time? To help us decode this, we are joined by someone who truly understands the pulse of global commodities, Mr. Vikram Dhawan, Fund Manager of Commodities at Nippon India Mutual Fund. Mr. Dhawan currently manages over 33,000 crore worth of assets across the multiple commodity-focused fund, including India's first global gold ETF. Mr. Dhawan, thank you so much for joining in. It's a pleasure to have you here.
Thank you, Dhruv, for inviting me on your show, and my hello to all of your listeners.
Uh, Great, sir. So, sir, let's begin. So, as of June 2025, as we talk, the world seems to be playing a geopolitical Jenga. Touch one piece and everything shakes. With conflicts brewing from Russia to Red Sea and the whispers of the new Cold War between the US and China, gold is suddenly no longer just a shiny metal, but it feels like an financial insurance mode. How do you see gold's role evolving in today's fractured world order? Is it still the last man standing in the times of crisis? What's your view, sir?
So, geopolitical, events have been there throughout the history. We had the world wars, we had so many, uh, the Cold War or subsequently. But what is different this time? What is different this time is that today we are no longer a bipolar or a unipolar world. We are now becoming a multipolar world. And this is the first time in the history that nuclear powers, countries which have got nuclear arsenal, they are pitted against each other. Um, I mean, what is happening in the Middle East, what happened between India and Pakistan, and even the Russian-Ukraine war also, at least Russia has nuclear weapons. So this has not happened in the history where such, you know, um, severe conflicts have happened between nuclear powers. So the stakes are very high this time. But more importantly, there has been a change. I won't call it a breakdown, but there has been a change in the world order, which after the fall of Berlin Wall and after the fall of the Soviet Union was dominated by the US. But I think with China now becoming a very big, important power in the world, and there is now, a lot of uncertainty on how this will play out. And most importantly, what we are seeing in this geopolitics is very unexpected development and very unexpected, approach and attitudes of each player involved in this. So this is a very confusing time for investors, for even normal people also, everywhere across the world. Uh, Very, we are having so much of problems in many of the regions in the world. So that is why. But then why gold? Why people are not, as in the historic, whenever as in the history, that whenever there used to be a war or a pandemic or a financial crisis, people used to flock to dollar. But why this is not happening is because the main buyers of dollars outside the Western world, which is China, Japan, India, and even the fringe European countries like Poland, they are now trying to diversify away from dollar. And just to give you an example, 25, 30 years back, the dollar composition of central banks' assets used to be about 75, 80%. Today, as per the latest report, it has gone below 50%. So you can imagine that this de-dollarization is not something which has happened overnight, but post the great financial crisis, there has been, a deliberate attempt by the central banks across the world, especially the ones in the emerging market and which are away from the so-called West or global North. They have been quietly diversifying away from dollar. So demand for dollar is going down, and what is benefiting is currencies like euro, yuan, Swiss franc, and also gold. So that is why gold is now no longer a tactical asset, but it is more of a strategic asset. So that's why gold is being viewed very differently after a very long time, I would say.
Right, sir. I agree on everything that you said. So, as we are talking about the de-dollarization, so I want to share some numbers. Like central banks bought around 244 tons of gold in this quarter one of 2025. It was more than 1,000 last year, I believe, which is more than 25% of the last 5 to 10 years of average. I believe that's not diversification. That's a declaration. Is this a vote of the no confidence in the dollar? Are we quietly witnessing the birth of post-dollar era, with gold playing the role of the global neutral?
So today, the reason why the US dollar is still, uh, the most sought after or the most popular or the most, preferred currency is because of liquidity. There is no currency in the world which has got liquidity equivalent to US dollar, and that is what is keeping it, still pretty much alive and kicking, as I would say. Neither euro, yen, yuan, not even gold has the same liquidity as the US dollar has. So I think as a medium of exchange, dollar, it'll be very, very premature to write off the dollar as of now. But what is happening is that, earlier it was no longer not just the preferred medium of exchange because of liquidity. It was also a preferred asset for both private and sovereign, investors. But this is changing now. So you may still continue exchanging or doing foreign exchange transactions with dollar as a base. That may continue, but the tendency to hoard dollars or to have outsized allocation to dollar, that will change. So I think I don't see the liquidity of US dollar being replicated by any other currency, at least in the foreseeable future.
Right. So I agree that liquidity has been a main pillar of the dollar, but the signs of it we are already noticing in the gold as well. So, sir, is it possible that we are heading towards a future where the physical gold isn't just a reserves, but the collateral for the entire trade agreements? Is it possible that we see an uptick in the gold-backed trades?
So typically, what happens is, let's say when you give invest in a company or give money to a bank, or wherever you put your money, you see the balance sheet of that entity, how strong the balance sheet is. So maybe 15 years back, 20 years back, the more dollar you had, the more it was perceived that your balance sheet is strong. But that is changing because of the fiscal situation of US. US has been running a very outsized fiscal deficit for a very long time, a trade deficit, a massive trade deficit for a very long time. And what has happened is that today their balance sheet uh, looks more like an emerging economy, in the sense, if you take away the US exceptionism, if this kind of balance sheet existed with, let's say, an emerging economy, it would have not been given very high rating, not even a single A, or even a B, a higher B. So it's just because of the US exceptionalism that investors are still ready to tolerate the higher debt, which, so the debt to GDP ratio in US is almost 100%. You may argue that, that's not an issue because most of European countries have that. Japan has more than that. But fact of the matter is that Italy having a debt problem is a $4 trillion problem, but US having a debt problem is a $40 trillion problem. So the quantum changes. So don't be fooled by the ratios. You have to also see, it's like losing 1% on a portfolio of 10,000 rupees and losing 1% on a 10 crore portfolio may look same in percentage terms, but in quantum it is very different, very different. So I think we are talking about numbers here which are very worrying. And the worst part is that this will get only worse, not only for US, but for all the developed countries, or the so-called global north. The debt situation, the debt to GDP ratio will deteriorate further in the coming years and decades, which means that gold will increasingly look a better option, because you have to understand one thing: gold is the only asset which doesn't carry any credit risk. So the one way to hedge your credit risk is that you put gold. So if you are holding US dollar, or currencies of countries where the fiscal situation or their balance sheets are not looking great, so how do you hedge that? You have to keep gold, because nobody, gold cannot be defaulted upon.
Right. So, yes. So basically, as we speak, I was also looking at the credit default swaps rate. So most of the time, the America was enjoying the AAA rating. There was no default risk premium that he was carrying. But right now, even after being rated as a double A, it is trading somewhere around triple B. So it is acting more like an emerging economy. I completely agree on your point. So, sir, let's talk more about the gold. Historically, it's been more of a money, jewelry, or wealth. But today, it has become a policy, power, and a politics. So, what makes gold so special that even after 5,000 years, it is still seen as an ultimate store of a value?
First of all, the gold supply is finite. Unlike the paper currencies, it is finite. But the most important thing, which perhaps not many people know, is that gold is one of the most liquid assets in the world. So U.S. Treasuries are the most liquid assets, followed by maybe S&P 500, but then comes gold. So gold is amongst the top three, top five liquid asset. It's S&P 500 has got 500 companies. Dow Jones index has got X number of companies, but this is just single asset. So from single asset perspective, it is, if you leave aside the US dollar, it is one of the most liquid asset. That is why the central banks love it. I mean, why do you think they're buying hundreds of tons of gold? Because they can sell that also if needed. God forbid. So liquidity is very important. And why do you think the Indian household also buy gold? Is very liquid. It is fungible with cash. So the most important aspect of gold is liquidity. It may not be as liquid as the fiat money, but then it doesn't have the risks of the fiat money also. So if you do the trade off, liquidity versus risk, gold definitely is looking increasingly better, because even in the emerging economies, the debt to GDP ratios will deteriorate in the next few years or few decades. When the growth boost starts tapering off, then I mean, you have to look towards Japan or Italy to see the future of fiscal mismanagement, or of a crisis, a consequence of a crisis, how every country can end up if if the luck is not on their side, the economy stops growing. So that risk is always there. So I think increasingly, if you look towards gold, it is looking better and better as we go in the future.
Agree. So now, as we are comparing it with the paper assets, in April 2025, recently, the gold has hit a record about $3,500 an ounce. I believe that's not just an inflation, it reflects the distrust in the paper assets. So, about the recent rally, how much do you think it was fundamental and how much do you think it was driven by the fear and uncertainty?
See, first of all, the central bank buying is price agnostic, because they're buying it for asset allocation. It's like, if you let's say, if you in a multi-asset allocation strategy, uh, you don't wait. Multi-asset will have equity, debt, gold, etc., but you don't wait for equity to get cheaper to buy or gold to get cheaper to buy. You buy it all at once, right? That is the beauty of multi-asset allocation. So central banks are price agnostic, because for them it is asset allocation or diversification. Also globally, especially in China and India, the investors are warming up to multi-asset products and multi-asset strategies. I mean, if you look at India, the the percentage AUM in multi-assets is very small. I think it is not even 1%, or close to that, 1 or 2%, very small. Whereas if you go to the Western markets,
Yes.
Europe, US, the investment into multi-asset strategy or similar strategies can be as high from 5% to 30%, depending upon each country. So obviously, globally in the emerging markets, especially as they become more affluent, the size of the portfolios increase, the awareness increases. There is, I mean, the fact that we are having a seminar with you on gold, and only gold, it means that there is an eagerness and inclination by the investors to understand how they can benefit from gold in their investment portfolio. So I think these are all changing trends. But obviously, unfortunately, the investment demand or central bank demands, especially the investment demand, tends to be very chunky. As we have seen in equities, that once the FIIs or the DIIs start buying, then you see this surge in the equity prices. But in case of gold, it is also a commodity. It has to be consumed in form of jewelry or ornaments or bars, etc. But the demand, physical demand, is steady throughout the year, or that with seasonality. But investment demand tends to be very spiky, so that creates these price spikes. So that's why I always warn investors that whether it is gold or silver or any commodity, if you're a long-term investor, you should not chase momentum. The best time to go buy gold is when nobody's talking about it.
Exactly, sir. Right. So you are someone from an industry and you have, very much insights into it. So if you can just give a sense of like, apart from the central bank demand that we are talking, are sovereign wealth funds, pension funds, or even the large institutions, are they increasing their gold exposures quietly?
So very recently, China allowed its insurance companies to invest into gold. Now, why they are doing it? Because the insurance companies across the world, are their portfolios are very bond heavy. They tend to invest in bond. Again, credit risk. So it's a very smart strategic move by China that okay, if suppose the debt crisis in China or how which is being led by which is happening because of the housing crisis, if the quality of uh, government sovereign paper or government paper deteriorates, then how do you hedge that? One way is obviously default, uh, swaps, but you can do only that much in a closed market. The other way is that you blend the portfolio with gold and manage your credit risk. So this is something which has happened very recent. There is a lot of freedom to pension funds in the in the developed countries. Very difficult to say, and there are a lot of sovereign funds also which keep on dipping into gold. So, eh, and most of them are very opaque unless you do a sort of the analysis of their portfolio. But yes, off and on, you'll see large sovereign funds or large pension funds across the world. They do dip into gold, but that's very country specific. Um, in India, obviously, the pension funds or the insurance companies are not allowed to invest in gold. Who knows? That may change in the future. But again, this is why China has become so attracted to gold because 2 years back, it's a very funny anecdote. I'll tell you that a couple of years back, when I used to talk about asset allocation to the Indian investors, they used to ridicule me that, when equity is doing so well, why should we dilute our portfolio? Same thing happened with the Chinese 2 years back when they realized that their stock market and real estate market is not going anywhere. The only thing they could do was, either to sit in cash or to buy gold. And it was not just the Chinese central bank, but the Chinese retail investors started buying gold. So, and that's what we saw in India also in 2024. The flows into gold ETFs were almost 3 to 4 times of the previous financial year. So yes, obviously, unfortunately, you need a bit of turbulence to understand that there is a risk. That's why now the world is realizing that it's not a very smart thing to put all your eggs in one basket. You need to diversify.
Exactly, sir. So, sir, now let's move to silver. Now that the silver has crossed $36 an ounce, the industrial demand has been skyrocketing. Are we finally witnessing silver stepping out of the gold's shadow? Silver is now very much essential for the solar panels, electric vehicles, 5Gs, or the medical devices. Just the solar industry could eat up over 140 million ounces a year. Is silver becoming the new energy metal? How do you view silver?
So 10 years back, 2015, solar used to account for only 5% of the consumption. Today, it is
Right.
almost 3 times of that, 15%. And if you look at the whole green tech sector, which was 7 8% 10 years back, I'm talking about 10 years, not 20 years, 2015. Now that accounts for roughly about 25 to 30%. So silver is it's the there has been a tectonic shift in the demand growth drivers of silver. But again, word of caution that these trends take time to unfold. If you're looking for quick gratification in silver, then it's in some places it is also called the devil's metal because of the volatility. And this is something which you need to handle with care. But yes, in terms of fundamentals, silver is the only frontline commodity which is in genuine demand supply deficit. And this is the fifth year running. But what will happen in the future? You will see divergence between the fortunes of gold and silver. Gold, as long as there is need to hedge against credit risk or debt risk or geopolitics, gold will continue to outperform silver. We don't know how long these things go. And just when we think that we have had enough, something happens. And as I mentioned, it is not just the geopolitical events, it is the aftermath, which is also very confusing for everybody. So, as long as the uncertainty and the question mark on US dollar remains in the foreground, gold will continue to outperform silver. Gold may continue to obviously you can never predict anything in these markets, and next day you'll be proven wrong and made to look like a fool. So gold may outperform silver in that context. Also, if there is a significant slowdown in the global economy, well, you have to understand China is struggling. The economy is struggling. If the U.S. economy also slows down, you are talking about top two economies which account for roughly about 31 more than one third of the global GDP. If those are slowing down, then very little rest of the world can do to make up to it. So if that happens, again, it is positive for gold, negative for dollar. But in a situation where the global economy surprises in the growth, and the Chinese economy also bounces back, then obviously silver will be one of the winners, one of the frontline winners in the commodity basket. So these things are very difficult to predict, what's going to happen, because we still don't know what will be the impact of tariff. The data of the impact of tariff will only start coming in the last quarter of this year. So before September, October, we'll not know what impact tariffs have had, how bad or how good. So I think things will be slightly more clearer by end of the this year. So that's why it is not silver or gold, it is silver and gold for your portfolio.
Right. So many retailers still believe gold is for the bad times, but we have seen gold rising even during the good times as well, like 2010, 2020, and post 2020 as well. So now, how can we reframe gold in the retail mind, not as a fear trade, but as a long-term wealth stabilizer?
So the reason why, uh, you have to now, when we will study the financial history of the world, it will be pre-COVID and post-COVID. I mean, earlier we used to say pre-World War or post-World War or pre-Great Financial Crisis. And post. But now it will be pre-COVID and post-COVID. Pre-COVID, gold used to behave very well. It was negatively correlated with the dollar, with the US yields, with S&P 500. It used to work beautifully. Because why? Because it was the investment money which was flowing, which was the elephant in the room, which was flowing from one asset to the other. If the investors liked equities, they sold bonds and gold and put money into equities. So both suffered, and or if they like bonds, then both gold and equities suffered. So this is what was happening. And if they like gold, obviously you have to sell bonds and equities because the same amount of money, right, which is floating around. But things have changed since COVID for a couple of reasons. First of all, the intervention of central banks has increased significantly. And not only that, earlier pre-COVID days or good old days of central banks were also obliged to give future for guidance on the trajectory of currency, on trajectory of economy, on trajectory of interest rates. But what is happening right now, the US Federal Reserve, which is the pivot for the entire financial markets, they have become data dependent. They don't give any guidance. So they, will, if you ask them too many questions, they will say, well, it is data dependent, will depend on data. So look at the uncertainty for even whether you're a common or an uncommon person. Look at the uncertainty over there, because every time you're trying to second guess the central bankers, which is what we don't need over here. So this has done is this has created an added space for gold, because the moment you increase uncertainty, the demand for havens for hedges increases. Because whenever there's a doubt, after all, you're playing with your money or your investors' money, and you have to be careful. There is no room for conjecture or speculation or guts over here. You are either you understand the situation or you don't understand the situation. If you don't understand the situation, the best way is to you hedge yourself, sit on cash, or buy some gold. So these kind of things. Secondly, the most important thing which has happened is that the central banks, which were buying at a steady rate of 400 tons per annum, they have come to the party in a big way. Now they are buying close to 1,000 tons, which I mentioned is price agnostic, which means And this also answers your previous question, which I should have mentioned there, that in 2025, after a hiatus of 5 years, the flows into gold ETFs in the Western world returned. And this combined with the flows by the central banks turbocharged the gold prices in 2025. So these kind of things will happen, so that is why the factors which are driving the gold prices today, yes, investors will still have, when you will see the flows into gold ETF globally increase, prices will go up. When the flows come out, you'll see volatility in the prices, that will happen. But that is not the sole driver of gold prices as of now. So this thing has changed very significantly. Thirdly, I would like to add that despite such high prices, physical demand has suffered, no doubt, but it is not collapsed. So the belief in gold by the retail investors is very much there. Unfortunately, they may not be able to afford as much gold as they could afford last year. But if you ask anybody, would they like to buy more gold? The answer is more likely to be yes. So the drivers have become more diverse, and they have become self-sustaining. We don't need a combination of macros now to decide the gold prices. The players will decide.
Okay, great. So I believe most of the why gold and silver has been covered. Now coming to the how. Now investors today have many choices like jewelry, coins, digital gold, sovereign bonds, or ETF and futures as well. Now, what do you believe are the smartest way to access these metals? Also, why?
So, first of all, you know, even if you are having a classic 60-40 allocation, 60 to equity, 40 to fixed income, um, still in today's world, because bonds have recently also become a source of volatility. I mean, they were never thought, interest rates were something which used to put people to sleep, but I think nowadays bonds are the one of the things which are not allowing people to sleep at night. The problem is not so much in India, but it is very much there in the US and the other developed markets. So the 60-40 portfolio pre-COVID was different. 60-40 portfolio is very different now. What can be worse is that if you are either 100% invested in equity or 100% out of equity in fixed deposits, and both are not advisable. But again, obviously, each investor has their own objective or their own reason to make their portfolio. We can only suggest the best global practices. At the end of the day, it is their money and their decision. So even in a 60 classic 60-40 portfolio, it has been proven that if you add gold, at least in the present circumstances, it brings down the volatility even of our 60-40 portfolio. And even obviously in an equity portfolio, it does act as a very strong hedge, reliable hedge. Even in a fully fixed income or a debt sort of a portfolio completely skewed, you can have gold, which more often than not tends to beat inflation. Then you have something which at least give you returns which will beat inflation. So there are various combinations, but the moot point is, how do you access that gold for your portfolio? So world over, the most popular way to do is gold ETF. Why gold ETF? Because of the liquidity. When I say liquidity, today if you buy 1 gram of gold, physical gold, from a jeweler, and you sell it after a week, the buying selling and assuming that the gold price has not moved for that 7 days, you would still be spending a good amount of percentage in the buying selling spread, what we call as the impact cost. Also, there always be a minimum size that you can buy in jewelry, or and obviously you not buy 1 microgram of gold physical. I mean, you at least need to see it, right? It should look that it has to have a look and feel. But in case of gold ETF, buying selling units, now one unit of on an average today's prices, the unit 1 unit of gold ETF is less than 100 rupees, which means you can buy gold worth in multiples of less than 100 rupees. And not only that, if you buy and sell that within a week's time or within the same day, the buying selling cost or the impact cost will be a very, very small fraction of what you would incur in the physical market. So this has made gold ETFs very popular. Entering and exiting gold ETF is this is so liquid that the impact cost is very, very less. Also, gold ETF, as per the regulations of SEBI, they have to be backed by physical gold, fully backed by physical gold. Gold bars of the best international standard, which is the LBMA Good Delivery, London Bullion Market Association Good Delivery, which means that the bars will only come by from those refiners which have been approved by the LBMA. So all these checks and balances are there. Plus, there is also a custodian, the which takes care, which is responsible for safekeeping of the gold, which, as per SEBI regulation, has to be an institution or a bank. So, and obviously, there are checks and balances and audits and everything. So, it is safety, security, liquidity, and convenience which have made gold ETF popular across the world. I'm not saying don't buy jewelry, because what jewelry can do, gold ETF, you cannot wear a gold ETF unit around your wrist or your neck. You definitely would need jewelry, and you should buy jewelry. That also appreciates in prices. But don't treat jewelry as an investment for the same reason I mentioned, because when you want to exchange it, God forbid, or maybe you need money for buying a car or a house or whatever, buying a parcel of land, then the impact cost of selling the jewelry and the realized gold value, there'll be a lot of haircuts on that. So don't treat jewelry. Plus, I think in the Indian culture, there's a stigma attached to selling your jewelry, because people may tend to frown that why that person is selling jewelry, has she or he gone under hard times, etc., etc. But all these things are not with gold ETF. So if you're not sure which form to buy gold, if you don't need jewelry right now, you don't know which design to buy, and you want to buy gold, your first port of call should be gold ETFs. And whenever you decide to buy physical gold or bar or jewelry or whatever it is, you can always, you know, exit the gold ETFs and then buy the physical jewelry, as the case may be. So I think gold ETFs are the best way to do it. There are also gold savings fund or gold fund of fund, which wherein in gold ETFs which are traded in the exchanges, you can buy through your broker, through a demat account, through the exchanges. There are gold saving funds where you can come directly to the fund house. It doesn't require any demat, and also you can do an SIP in that also. So these are the two products that you should look at as your first port of call. Same for silver. There are silver ETF and there are silver fund of funds.
Yes, so sir, I agree that there are a lot of advantages when you do it with the ETFs. One overlooked advantage is like the SIP ability basically in the ETFs, especially for the young investors. I believe they will be a very much of discipline builders from this age onwards. So I agree on this point. Now, if next decade is going to be driven by the multipolar world politics that we have just spoken, currency blocks, green revolutions, and the energy disruptions will be there. Now, what role do you think gold and silver will play in this new world? Will we head back to the metallic monetary regime like we had thousands of years ago?
So I think the a debt problem. I won't call it a debt crisis. The debt problem is pretty much on the horizon, because unless the countries grossly, reduce their standard of living, there is no way the kind of debt which is outstanding right now and which is increasing, which can be paid. I'm not saying this will lead to some sort of a sovereign default. Sorry, my throat. Sovereign default. But obviously, that's always a risk, a fear in the market. So gold and silver will become an antidote for that. You can't avoid paper assets because they are the ones which generate wealth. They are good wealth creators. You can't ignore them. So you will keep on investing in them. But at the same time, you would also need real assets. Now, real assets, if you're lucky enough to be living in a country or a city where the real estate is booming, then obviously you may prefer buying a house or land than gold. But if that is not the case, then obviously the other real asset which is popular with Indians is gold. I mean, still today, as per some statistics, which I don't have the source, 70 to 80% or at least two-thirds of the value of household savings or household wealth is in gold and in real estate. So, so I think the role of gold will increase from the investment perspective, from owning hard assets. Hard assets, if you look at Gen Z, they are a very asset light generation, and for by choice also and by circumstances also, because it's not easy to afford a house, not only in India, across the world. And so if you till the time you can't own a hard asset like a house, what is the best asset to give you that participation in inflation and have an alternate source, an alternate asset in your portfolio which protects you from financial and geopolitical calamities also, and climate calamities also. Gold and silver then become important even for Gen Z.
Yes, sir. So now one last thing. Now on the flip side, now what are the biggest risks to this bull case? If inflation falls and geopolitical tensions eases, will gold and silver lose their shine? How should retail investors think about this?
See, the ultimately gold and silver are commodities also. They are currencies, they are hedged, they are portfolio diversifiers, but they are uh, commodities also. So they have to be consumed. Whenever the prices move up too sharply, there tends to be demand destruction. This is temporary. This is not the first time that gold prices have gone up. But if you look at history, whenever gold prices have spiked up very sharply, because from now till last year, gold prices are up by about 30-40%. So not many people will be lucky enough to have additional 30-40% disposable income this time to buy physical gold. So this will lead to demand destruction. But what happens with demand destruction is that the demand eventually catches up because of inflation. Obviously, that is why gold is called an inflation hedge, because while in real terms your disposable income may not be increasing that much, but in nominal term, obviously it will increase. So you will catch up in buying the gold. So you will have these phases when the prices have gone up significantly, and the physical demand, the jewelry demand, starts lagging. Then you see phases of consolidation, and that's a time when people stop talking about gold. But historically, that's a time to buy. Actually, start adding to your portfolio, because see, gold has got more history than any stock exchange, any fund manager. It's been there for thousands of years. So you can't expect it to behave in a quarterly way or a monthly way or a weekly way. I mean, people who make calls, weekly and monthly calls, I find it very, very humorous, because if you really want to punt, there are a lot of other things to punt on daily, weekly, monthly, quarterly basis. So you need patience for that. And obviously, as I tell people that it is the only insurance policy which gives you returns, and you don't have to pay a premium for this. It actually gives you premium back. So if you're taking it like that, then any price is good for you. As I mentioned, for portfolio diversification, you need to be price agnostic. But obviously, if you're for tactical and for strategic reasons, you may want to look for a better time or place or price or etc. But there's never a bad time to buy gold if you're using it as a portfolio diversifier or a hedge.
Absolutely, sir. Absolutely. So, whether it's a global tensions, inflation, or the clean energy boom, gold and silver will continue to shine, each of their for their own reasons. They are not just the old world metals anymore, they are now part of the new world. So, sir, thank you so much for joining us today and sharing such a clear, eye opening insights.
Most welcome, and thank you very much for inviting me on your show.
Thanks a lot,
And
sir,
I
for
wish all your viewers and all your partners and all your patrons all the very best ahead. Thank you very much.
thank you so much, sir.